So for the sample problem for profitability ratios are the following selected data were taken from the financial records of South Corporation. Profit 1 million, average total assets 12 million, net sales 20 million, total shareholders equity 8 million, preference shares 4 million, ordinary shares 6 million. So to determine the return on sales, we will divide the profit over net sales. So 1 million over 20 million is equal to 5%. Then return on assets, profit over average total asset is equal to 1 million over 12 million with a total of 8.33%. So return on net shareholders equity, profit divide average shareholders equity is 1 million over 8 million is equal to 12.5%. Then return on ordinary equity, profit minus preference dividends over average ordinary shareholders equity. So, 1 million minus 2 million times 10% over 6 million. So, nakuha yung 2 million po is sa 200,000 times 100 pesos, 10 times sa 10% doon sa preference shares. So, return on ordinary equity is equal to 13.3%. Then, earnings per share is profit minus preference dividends over average ordinary shares outstanding. So, 1 million minus 200,000 over 200,000 shares is equal to 4 pesos. So, let's move on to the next subtopic, which is the growth ratios. The growth ratios are indicative of the organization potential and attractiveness as an investment option. So, from the word itself, growth sa growth ratio, meaning dito malalaman kung gaano kabilis lumalago ang isang business and measure din kung ano ang percentage ng lalago ng isang company. So, mahalaga merong growth ratio ang isang company to help them check whether their company is on growth, and it helps them to analyze their business trends over time, including the impact of new products and strategy changes. So, there are different aspects in growth ratio, which is the price earnings ratio, the dividend yield ratio, dividend payout ratio, book value per share, and the market to book value ratio. So, let's discuss it further. So, price earnings or PE ratio or the earnings multiple. So, the formula for PE ratio is market price per share over earnings per share. So, the PE ratio indicates the organization's ability to recover investments from earnings. The higher the PE ratio, the better. So, PE ratio indicate whether yung stock ng company ay kung mahal o mura ba yung price na ibebenta sa market. It helps the investors para ma-determine yung stocks market's value compared sa company's earnings. So, this ratio shows that the company is willing to pay today for the stock based on its past or future earnings. So, let us say we have two companies that belong in the same industry. So, which is the red company and blue company. So, the EPS are 40 pesos and 60 pesos for red and blue company respectively. On its face value, we can opine that blue company is better than red company. Profitability-wise, however, given red company market price per share of 100 pesos and blue company's 300 pesos, we can compute the PE ratio and develop a new line of data and interpretation. So, dito sa table, makikita natin na ang PE ratio ni red company is 2.5:1, then the blue company is 5:1. So, rational investor says sa red company is buy and sa blue company is do not buy. So, ang magiging market price per share sa red company ay mag-i-increase while sa blue company is decrease. So, the stock price will be more expensive sa red company and cheaper sa blue company. So, intelligent investor says not good investment daw ang red company and good investment naman ang blue company. Bakit? Kasi mas mura yung stock price ng blue company compare sa red company. And ang lumabas din kasi sa PE ratio is mas mataas si Blue Company. Eh, sabi nga kasi kanina is the higher the PE ratio, the better. So, a higher PE ratio means it takes longer years for an investor to recover his investment. Initially, it drives away potential investors to look for a company that could return their investment in a shorter period of time. As the company's stock becomes unattractive, the stock price dives down and becomes cheaper. Later, if a company's performance has been observed to be relatively stable, and its investment potentials are being unleashed, then the company is presently undervalued and would give a more attractive return in the long run in a normal business environment. So let's move on to the dividend yield ratio. So the formula for dividend yield ratio is dividend per share over market price per share. So the yield ratio reflects the ability of the organization to return investments to owners in terms of cash or dividend, not in terms of accrual profit. Investors are more interested in cash returns than in accrual paper income. This makes liquidity rather than profitability a priority of investors in relation to investment recoverability. So the yield ratio, as mentioned, focuses on the organization's capacity to provide returns to its owners in the form of cash dividends of other monetary benefits. This ratio differs from the accrual profit, which represents the company's profitability based on the accrual accounting method, where revenues and expenses are recognized when they are earned or incurred, rather than when they are received or paid. So investors often prioritize actual uh, cash returns over accrual paper income because cash dividends are tangible and can be used immediately for various purposes, such as reinvestment or personal expenses. Accrual profits, on the other hand, are theoretical values that may not always translate into real liquid returns for investors. This preference for cash returns over accrual profits highlights the significance of liquidity for investors when evaluating the recoverability of their investment. So, liquidity refers to the issue with which an asset or security can be converted into cash without affecting its market price. So, dividend payout ratio. So, formula for dividend payout ratio is dividend per share over earnings per share. So, uh, the payout ratio indicates how generous management is in distributing its earnings to owners. A high payout ratio means management is confident on the stability of future cash streams. Hence, they can dispose of their current cash and satisfy the liquidity interests of its owners. A high payout ratio attracts investors to buy stocks, pumps up at the company's market value, increases its cash inflows from financing, and creates more organizational wealth in the process. So the payout ratio, as described, is an essential financial metric that demonstrates the proportion of a company's earnings that are distributed as dividends to its shareholders. A high payout ratio signifies that management is generous in distributing earnings to its owners, indicating confidence in the stability or of future cash flows. This confidence allows the company to dispose of its current cash reserves to satisfy the liquidity interests its investors. A high payout ratio can be an attractive feature for potential investors as it demonstrates the company's commitment to sharing profits with its owners. This, in turn, can lead to increased investors' interest in purchasing the company stocks. As more investors buy shares, the company's makes value rises, which can further boost its cash inflows from the financing activities, such as issuing new stocks or debt. So, the book value per share. So, there are two formula for book value, which is ordinary share and preference share. So sa ordinary share is ordinary shareholders equity over ordinary share outstanding. While sa preference, similar lang sila ni ordinary, kaso preference lang yung ipapalit sa ordinary. Preference shareholders equity over preference shares outstanding. So, ordinary shareholders equity is total asset less preference shareholders equity. Preference shareholders equity is liquidation value plus applicable preference dividend. It depends on the type of the preference share as to whether cumulative and non-cumulative shares. Cumulative preference shares have the right to receive dividend in arrears as well as the current year's dividend. Non-cumulative preference shares are not anymore entitled on the prior year's undeclared dividends. However, is entitled for the current year's dividend. Book value per share is a measure of company's wealth based on the value of its net assets. For example, owner's equity. The net assets of a business is valued on a mix of objective prices such as cost, net realizable value, market value, um, and even discounted value. Essentially, the book value per share is based on the accounting measurement method used, which is predominantly based on cost or fair value. Its drawback is that it does not incorporate the market price of the shares of stock, does not reflect the potential of the company's growth, and is not reflective of the objective business valuation as at a given time. So here are the sample problem for growth ratio. Russell Corporation provided the following selected financial data of Strawberry Corporation on December 31, 2020 CY. So, earnings per share is 25, market price 125, dividend per common share 10, average shareholders equity 4,200,000, preference shares 1,200,000, preference dividend on arrears 288,000, ordinary shares outstanding 80,000 shares. So, the formula, so since na-discuss na din halos natin to, so hindi natin babanggitin isa-isa yung mga formulas. So, for price earnings ratio, we will divide the 125 over 25 is equal to 5 is to 1. Then dividend yield ratio, 10 divide 125 is equal to 8%. Payout ratio, 10 over 25 is equal to 40%. So, book value per preference share and ordinary share. So, preference share has 10.44 pesos since we get 2,088,000 book value per preference shares. Kasi, pinag-add natin yung liquidation value sa dividend arrears. So, nakuha natin yung liquidation value sa 200,000 times 90 pesos times the 10%. So, it's equal to 1,800,000. Then, 2,088,000 times divide 200,000 shares. So, is equal to 10.44 pesos. While ordinary shareholders equity naman, we will less the total shareholders equity sa total preference equity. So, we will get the 2,112,000. So, divide 800,000 shares. So, is equal to 26.40 pesos. So, let's move on sa liquidity, the liquidity ratio. So, liquidity refers to the ability of the business to pay its obligation in cash as they mature. Therefore, the focal point of liquidity analysis is cash. It includes the ability of the management to convert its current assets into cash in a quick, stable, and regular manner. It also deals with the ability of management to use trade credits and stretch the payments to trade credits in financing operating activities. So, liquidity is a crucial aspect of a business financial health as it ensures that organization can meet its financial obligation as they come due. By focusing on the ability to generate cash from current assets and effectively manage trade credits, businesses can maintain a strong liquidity position, which can lead to increased investors' confidence, better access to financing, and overall organizational stability. So, primary liquidation ratio. So, inventory conversion cycle measures the number of days it takes for a company to buy and sell its inventory base. The receivable conversion cycle measures the number of days it takes for a company to collect its base receivable. The total days it takes for a company to sell its inventories and collect its receivables is the operating cycle. The inventory conversion cycle and the receivable conversion cycle are essential metrics used to evaluate a company's operational efficiencies and liquidity. This cycle help in understanding the time it takes for a business to convert its resources into cash through the sales process. The inventory conversion cycle measures the number of days required for a company to purchase inventory and sell it in finished goods. So this cycle is crucial because it helps the efficiency of the company's inventory management and production processes. A shorter inventory conversion cycle indicates that the company is effectively managing its inventory, reducing the time and resources tied up in unsold products. On the other hand, the receivable conversion cycle measures the number of days it takes for a company to collect payment from its customer after providing goods or services. This cycle is an essential aspect of a business cash flow as it reflects the efficiency of its credit and collection policies. A shorter receivable conversion cycle suggests that the company is efficiently managing its credit terms and collecting payments promptly. So here are the primary liquidity formula. So inventory turnover is cost of goods sold over average value of inventory. Then the formula for days sales inventory is ending inventory over cost of goods sold. Then receivable turnover, net credit sales over average trade receivables, uh, collection period, um, 365 days over receivable turnover. Payable turnover is equal to net credit purchases over average trades payables. Then lastly is payment period is 365 days over payable turnover. So these formulas are sometimes referred to as activity ratio or effectiveness ratio. So many analysis use the 365-day year in analyzing the conversion cycle. Inventory turnover indicates the effectiveness of the business in selling its inventories. It determines the number of times the entire inventory base is sold in a given period. The receivable turnover measures the effectiveness of using the investment in receivables to generate net credit sales. It measures the number of times the receivable base is used in a given period. The higher the turnover, the shorter the conversion period, the shorter the operating cycle, and the more liquid the business will be. So here are the sample problem for primary liquidation ratio. So here are the following selected data from the records of David Corporation and Dean Corporation as of for the year ended December 31, 20 CY. So net credit sales, David has 60 million while Dean 120 million. Cost of goods sold 20 million for David and Dean is 40 million. Net credit purchases 20 million for David and 43 million for Dean. Then average trade receivables, they have both 4 million. Average inventories also they have both 2 million. And average payables, they also have 3.5 million. Then sales credit terms, meron din silang 2 over 10 to N over 30. Then as well as the purchases credit terms na 3 over 30 to N over 60. So, determine the following for David Corporation and Dean Corporation for 20 CY. Use 360 days per year. So, so here are the solution. So, inventory turnover. David has 10 times since 20 million over 2 million is equal to 10 times, while Dean is 22.5 times. Days to sell inventory, David Corporation has 36 days, while Dean Corporation is 16 days. Receivable turnover, so David Corporation has 15 times, then Dean Corporation is 30 times. Collection period, 24 days for David Corporation, then 12 days for Dean. Payable turnover is 5.7 times for David and 12.3 times for Dean. And lastly is payment period. So, 360 since sabi kanina is 360 days ang gagamitin. So, 360 days over 5.7 times is equal to 64 days. Then, 360 days over 12.3 times is equal to 30 days. So, the continuation of this topic will be continued by Miss Janine.